on Facebook.
Well, happy Thursday. It is an amazing day. Megan rushed from Glendale, thought we were going to be starting without her. I had the whole team up in arms about how to make sure that we got this set up for you guys today, because there is so much to talk about. I know that Megan's got a whirlwind of information on what's happening in the real estate market. And I'm going to be talking a lot about the headlines that your clients are reading, the fear that is being bred out there, and then how you can combat some of that. So let's start with the quote, because I thought the quote was actually very apropos, and it comes from Nelson Mandela. Education is the most powerful weapon which you can use to change the world. This is our opportunity. When we talk about the kind of wealth that you can develop through real estate, when we talk about real estate being a hedge against inflation, we talk about the opportunities that the other 90% of us, not the top 10% that are paying over 100 million for a 1955 Mercedes, but the other 90% of us, that we can actually put ourselves in a better position for our futures and for our todays. And that is through real estate. So Miss Megan, what is happening in real estate today?
Oh my gosh, it's been a busy week. As you know, every month I have to go through and turn over all of the data. So not only do I have the updated monthly reports for you that we'll go over for very quick, but I also have the weekly report for you as well to go over, because there's been a big shift in the transition. It's kind of interesting when I go through and I do the monthly report versus the weekly report. The weekly report is obviously going to be more up to date because I base it off of pending transactions. But the old report for the monthly data is more attuned to what actually went under contract back in April, closing in May. So there's going to be a big transition in the way that the numbers report themselves. And so I'll go ahead and share the screen, and we'll start out with the monthly report so that you guys can see all of those numbers. And I'm going to zip through some of this stuff pretty quickly so that you guys can see what I'm talking about here in this report from current slide. So looking at all of the numbers, I do have the one-page snapshot that you guys can use. This is something that gets shared a lot on social media, just so that you guys have a one-page dump of everything that's been going on. But looking at what happened for May, what was interesting to see was our month supply of inventory came up by 85.9%. And I had a big jump in the number of active listing counts for month-end active listing counts. Oh. There we go.
There we go.
There was a big jump in the month-end active listing count where it came up by 86.1%. But for detached single family alone, we now have 3,100 total units for sale. Between both attached and detached, we're now over 4,000 units available for sale, which is up from the 1,000 that we had for sale back in January and February. So we have a huge jump in the amount of active inventory that's on our market. As we continue deeper into June, July, August, and September, what ends up happening is we end up seeing our active inventory going up. I don't think that we're going to hit 5,000 like what we typically see going into June, July, and August, but I think that we could be up to that 4,000 number, where we're getting closer to something that was more streamlined, like what we had seen from 2013 through 2020 through 2019.
Now, what are those numbers? Are they an average of past years, or is that last year's numbers?
So this is an average of the last 7 years of data. Last 7 years of data since we've been in an extreme seller's market. And the blue bar that comes in, this is the actual active count for this current year.
Because I was talking, I have a slide in the second half talking about inventory, which I'll blow through now because we're talking about it right now. But the comparison of not only this year's data, but to the average, right? Because forget about balance, forget about 6 times what we have or what we need for by closed, because that's just an extreme that we won't hit, especially not in the Denver market.
Right.
But to hit even the average, so we just year over year went over what we saw last year in active inventory, but not even quite near 2020 or 2019 yet.
Right.
And that was, I was reading some other reports talking about that's where we start seeing the kind of inventory that we need.
Yes. And so year over year, we're actually up 70.8% in terms of our active inventory. So a lot more active inventory this year than what we had seen in years past. Pending transactions came up month over month by 22.7%, but there are still fewer transactions that are happening this year than what happened last year. We're down by about 8.5%. Closed transactions were up by 5.8% year over year. So again, we had an early selling season this year. So a lot more closings happened earlier this year than will happen in the second half of the year for 2022. But our predicted month supply of inventory actually came up to 0.8, which is the highest that number has been in about 2 years. And so again, a lot more choices out there for buyers buyers, you're going to find that you're going to have those conversations with your sellers that you may not be under contract in the first weekend.
Right.
And to set that expectation, and you might be going back to doing open houses. And now you're not having to run out at the very beginning of every day and see what's in the MLS to run and show your clients properties at lunchtime. And so hopefully that gives you guys a little bit more time in the marketplace. Looking at month supply of inventory broken out by price range, we're still south of 1 month of inventory for everything that's under 1.5 million, indicating that multiple offers are still very likely in those, but those numbers are growing. They're definitely higher than what we had seen back in January and February, where we were down to like 0.2, 0.3 months worth of inventory at lower price points. Looking at the 1.5 to 2 million or to $5 million price point, we're looking at 1.5 to 2.5 months worth of inventory. And so again, still strong numbers overall, but the market has calmed substantially. And in the $5 million market or more, we're sitting at 7.8 months worth of inventory. I still wouldn't call that a buyer's market for that particular price point, because this life cycle for a listing for those properties is a lot longer, but it is stretching out. And that's the longest that I've seen that in about 2 years as well. When we look at it broken out by the heat map, looking at month supply of inventory, the rural hotspots still continue to be over here on the eastern edge of Denver and the western edge of Aurora, getting down here into some of the hilltop communities out here in Lakewood and Littleton. Those are still some really orange hotspots that are going on, but we noted a cooling trend that happened up here in Broomfield with 1.54 months worth of inventory just south of Green Valley Ranch out in Aurora. This is 80113, I believe, 2.06 months worth of inventory. And then down here south and east of Castle Rock, we're seeing a cooling trend out here in the Parker area as well. Sterling Ranch, we ended up seeing that came up to 1.84 months worth of inventory. So that's also transitioned down there as well, where it's cooled substantially just in the last month or so. Lodo continues to be a little bit of a sore spot. In Lodo, we have about 1.75 months worth of inventory, sitting around 2 months worth of inventory there. So again, that market's going to feel a little bit cooler in Lodo than it is in other parts of those outer ring landlocked suburbs. Looking at odds of selling, the odds of selling dropped month over month by about 1.8%, so down to 79.6%, and that's down 7.6% from where we were 1 year ago. Now, again, the odds of selling is where I take into account all of the available listings for sale versus those that go under contract and or close in the same month. So if you put up a listing in the month of May, it had an 80% chance of selling during that given month, with 20% of the listings taking longer than 1 month to sell. Looking at that, usually that number has come down about 8% from just the previous month. And so again, the odds of selling is starting to wane. That number is likely to continue to decline through the end of the year, since we had our big pop of activity back here in January and February. The odds of selling still remains over 50% for all homes that are up to $2 to $3 million. And so again, a really good high odds of selling. Highest odds of selling is in this $400,000 to $600,000 price range with a 77% odds of selling. Looking at, again, the hot spots in Denver, we continue to see these hot spots that pop up down here in Lone Tree and Littleton, Lakewood, Littleton, getting out here into some of the Arvada areas. Those are a little bit more red as well. But that eastern edge of Denver, western edge of Aurora, getting into Central Park and Montbello are really the hottest spots here in Metro Denver right now. The highest odds of selling was 85.7% odds of selling. And so again, really good odds of selling out here if you're looking for some year-end transactions or to do some farming or prospecting. Focusing your efforts out here on this 225 corridor, you're going to have some really good results. There's also a little hot spot that continues to exist up here in Thornton and North Glen. Cooler spots tend to be in Lodo, down south and east, just south of Green Valley Ranch, and then also Sterling Ranch, where it dropped down to 54.4% odds of selling. Showings were way down this month. We ended up having a really distracting month with all of the different holidays that happened during the month of May. And so we have Memorial Day, all of the graduations, Mother's Day that's happening. June is going to be similar with the with holidays and that are going on. We've got Father's Day, and then we've got Juneteenth that's on June 20th. And so again, a 3-day holiday weekend where things are likely to cool over that weekend as well. So avoid listing over those weekends if you can. But we should have had 8.3 shows per property. There were 7,700 total showable properties that were available during the month of May. And so again, a lot more total showable properties that are out there. That was up month over month by about 21%. And year over year, that's up by about 20.3%. Shows depending, it should have been about 12 to 13 showings should have yielded you a contract. That number is holding really constant. And so again, if it's taking 8 showings to get 8 shows per property per week, then we're looking at 12.6 shows per property to go under contract. We're looking at about a week and a half to go under contract at that point. So again, not going under contract that first weekend. Days depending, we had 77.4% that were under contract in 7 days or less. Median days on market still sat at 4. Average days on market was sitting at about 9. Looking at broken out by price range, you're less than 2 weeks on market for anything under 2 million. Once you go over 2 million, you're bouncing between 2 and 4 weeks on the market at that point. Fastest days on market down here, look at that southwest corridor of town. Wow, really fast down there. Looking at 5 or 6 average days on market. Over here in Applewood, we were looking at 4 average days on market. Getting out here into that eastern edge of Denver, western edge of Aurora, 6 or 7 average days on market. Not to mention all of the stuff that's happening on the north side of town, seeing a little bit longer there. Longest days on market was sitting here in Lodo at 31 average days on market for that particular market. Looking at pending in 7 days or less by zip code, Evergreen came in with an 88.5% of those homes under contract in 7 days or less. Applewood, again, 91.9% of the homes were under contract in 7 days or less. Down here on the south and west part of town in the Highlands Ranch and Lone Tree, we're also looking at about 90% of those homes under contract in 7 days or less, and a lot lower as you got out here into some of this stuff that's just south of Green Valley Ranch, where it was only 43% of those homes under contract in 7 days or less. Average sales prices finally fell. So this is the first month that we ended up seeing average sales prices fall, and this is due to rising interest rates, affordability, and buyer fatigue setting in. We also have a lot more inventory in our market than we did back in January and February. So a lot of those multiple offer situations have started to die down. We're still seeing multiple offers, but not nearly to the same degree that we were seeing them back in January and February. Average close price was $801,000 for the 7 Metro Denver County area, and that's down by 2.1% month over month. That's likely to continue to cool headed into June, July, August, and September. Usually by October, we end up leveling out in terms of our average sales price for the rest of the year, but that's up 15.8% from where we were 1 year ago. If we're looking for a quick number to show a pseudo appreciation number.
And some of that is just coming off of the accelerated multiple lists or multiple bids higher than list price, right?
Yep.
I mean, we're not talking about people losing value. It's still 15.8% over last year, but that is that cooling off where you only have one offer. Maybe you go a little under list, or maybe it's right at list where you don't have that.
Right. Where you're not having to give up an arm and a leg, your inspection and your appraisal gap in order to go under contract. We're starting to see homes hang out on the market for longer. And the common Facebook media, social media trend that I'm seeing is that it's, hey, this market made it through the weekend. Bring your FHA and your BA buyers because they have a chance once the property's been on the market for the second weekend, where it's not going to be in a multiple offer situation, and those loan terms could be more favorable at that point. But again, usually what happens, we end up seeing that home prices usually go up about 1% in May and up another 1.7% in June. What I'm projecting is that we're going to be below the 0 mark, and home prices are going to continue to fall through about September. Looking at average sales prices broken out by price range, obviously it's less expensive as you get out here into the north and east side of town. Our most expensive zip code was Cherry Hills Village, and that came in at an average sales price of $1.9 million in that price range. Looking out here, and as you get out into the foothills communities, you're well over $1 million into those communities as well. Close to list price ratio came down quite a bit. We were looking at 105.3% of their last asking price and 104.9% of their original price ratio. That's down month over month by 1.9% and down 2.1% for the original to close price ratio going month over month. Looking at where we're seeing the most offers going for over asking price, Conifer and Pine came in at one of our hottest spots, where we ended up seeing that it was going for about 8.6% of its close to list price ratio. Over here in Greenwood Village, we saw 110% of its close to list price ratio. Inglewood was another hot spot where it came in at about 109% of its close to list price ratio. And then down here into Carroll Valley, we're looking at about 108.1% of its close to original price ratio. Some hot spots out here in Lakewood, and also getting out here into Central Park was another desirable neighborhood last month, where it came in at about 108% of its close to list price ratio. Cooling spots, again, down here as we get into Sterling Ranch, where it was 100.9, it's still over 100, but we're still seeing that it's cooling compared to the rest of Metro Denver, and cooling as we start to get down here into the Parker and Castle Rock territories.
Yet the average close price went down.
Yet the average close price went down.
Still, or People are
it's-
paying more.
but
So
people
they're
are paying more.
coming out with better prices.
Yes.
Yes.
So we're seeing more price reductions definitely across the board. Interest rates and affordability. This was an interesting number. Principal and interest payment for an average priced home in Metro Denver was $4,032. The average 30-year fixed interest rate for the month of May was 5.23%. Year over year, your P&I payment is up 52.1% from where we were 1 year ago. So that speaks to rising prices and rising interest rates, how quickly that compounds and drives up your principal and interest payment. But it's still not a bad time to buy, and interest rates aren't bad. Did they come down? Interest rates came down, didn't they?
And went back up.
And went back up.
I'll show you that.
Never
They
mind.
sure did.
Never mind. But again, we should start to see some slow depreciation as we go into the next couple of months. And so usually what happens when we see our portion of our principal and interest payment that comes out of our household income, once that number tips over about 30 to 35%, appreciation starts to slow because we have an affordability issue that happens. And so that's going to be coming in the next couple of months where prices tend to cool down. Multiple offer analysis of those that closed in the month of May, it was 73.5% of all the homes were in a multiple offer situation. The vast majority of them up to $5 million. So again, over half of them were under contract. I'm sorry, for over asking price. In the $5 million mark, it was 1 out of every 4 that were under contract for over asking price. We saw the most multiple offers down here as we got into Greenwood Village, where it was 94.7%. And then also up here into the North Glen and Thornton corridor, where it was 98.5% of the homes were selling for over asking price. Some hot spots still exist down here into Ken Carroll Valley. Things really cooled off in Lodo, where it was 34.7%. And then down here south and east of Castle Rock, where things cooled down a lot too. The amount that you're having to go over asking price if you are in a multiple offer situation has also calmed down. If you remember back in January and February, this number was hitting 8 or 9% for homes under $1 million. We're still seeing some significant multiple offers for homes that are between $1 to $4 million, where we're seeing between 9 to 12% over asking price. If you're in a multiple offer situation, so we're talking about hundreds of thousands of dollars over asking price in those price points. In the $5 million price point, it was an average of $500,000 over asking price if you were in a multiple offer situation. Looking at where we're seeing the highest offers over asking price, that the foothills communities are just on fire. Again, there's that clear line of demarcation that runs along I-25. Anything west of I-25, you're still paying premium prices for. It's between 8 to 12%, whereas it used to be between 10 to 15% over asking price. And to the west of I-25, you're looking closer to about 4 to 7% over asking price at this point. And that's calmed from 5 to 10% over asking price in previous months. Price reductions, there was 9.7% of the homes that closed in the month of May had price reductions. I go off of my weekly numbers instead of this number because it's going to be more accurate, because I can track this as soon as the unit goes under contract, how many price reductions they had. And so again, this number has greatly accelerated since Easter. And so again, we'll go over that when I hit the weekly numbers for you.
What is our average? Because I know nationally, 33% is the historical average of homes doing a price reduction.
Yep.
What do we see here in Denver?
So usually what we see here in Denver, units with price reductions for the month of May, we end up seeing 18.4% or 19.5% as we get into June. We're sitting at 9.7% are making price reductions. We're seeing the average price reduction, people are cutting deeper. Usually what I see when price reductions start to roll around is that we end up seeing more widespread but smaller price reductions. I'm seeing more widespread, larger price reductions that are happening, where people are really trying to get back in front of the market right now. 5.1% again was the average price reduction. Usually it's about 4.9% in the month of May. So like slightly larger price reductions overall. Price reductions that we're looking at for under $800,000, you're looking at about a 4 to 4.5% price reduction. As you go up in price range, your price reductions get larger. Largest price reductions were down here in Cherry Hills Village. We saw a 35.9% average price reduction. There was one property that was really high priced that came down a whole bunch. And so that kind of skewed this graph a little bit, but we're seeing cooling trends as you get down here into Lone Tree as well, where it was about a 17% price reduction as well. Distressed transactions.
Can you read that?
We had one. We had one HUD property that closed in the month of May.
Colorado as a whole is 0.1%.
0.1%.
Yeah, it actually dropped.
So yeah, not a whole lot of price reductions there. I have just enough time to go into some of the beginning slides of the weekly report that we have for you guys. So we'll hop into that really quick so that you guys can see that. Display settings, duplicate slideshow. There we go. So this is for the week of June 1st through June 7th, looking at what's been happening just in the last week or so. Again, the cooling trend really continues to settle in as we start to see more inventory making its way to market. These last 2 weeks, we've really seen a jump in inventory and making its way to market. Now that kids are out of school, people are wanting to move over the summer holidays. And so again, listings are way up going into this, and showings are down from where we were just in the last couple of weeks. Based off of our predicted month supply of inventory for all price ranges, we're looking at about 0.6. And so again, that number came down from Memorial Weekend where we were at 0.7. We're now at 0.6. And so we expected to see some sort of a rebound in the market where the market would pick back up again as we went into 0.6 months worth of inventory. Our average daily active count was 3,414, and that's up 60% versus the same week 1 year ago. So a lot more inventory this year than what we'd seen in years past. Pending transactions rebound by about 24.4%, where we put about 1,300 units under contract. That's off from where we were 1 year ago by about 21.5%. So again, our buyer pool fatigued early this year with interest rates and the tenacity of our market that we had back in January and February. Back on markets ended up seeing a little bit of a spring. We saw a 35.6% increase in the number of back on markets. Again, we end up seeing that it's about 40% of these back on markets were in a previously under contract status before they make their way back to market. And so again, 305 back on markets for that week. The odds of selling only rebounded slightly. We continue to see that cooling pattern, and it's likely to continue to cool through the end of the year, but the odds of selling came up to 73.8%, which is better than where we were over Memorial Weekend, but not as good as the weekend before that. And that's really cooled from the 87.3% that we saw back in January and February. So the odds of selling is off from 1 year ago by about 12.1%. Again, we had our selling season early this year. Looking at shows per property, we were looking at about 4.6 shows per property. It rebounded ever so slightly, but not as much to the weekend before. This still only has showing time data in it because I can't get data out of Broker Bay yet. And so again, you can add in 1 or 2 showings probably per week for these properties, but it's about, if you put up a new listing last week, it's about 4.6 shows per property.
You think somebody from Broker Bay would watch this and call you
and
say, let me teach you or let me help you get the data, right?
I know. Well, I go to the page for analytics and it just sits there and spins. Nothing pops up. And so short of going directly to them, I'm not sure how to get that data out of there. And so because I can't pull it myself, the system isn't working with pulling analytics. Looking at the number of shows to go under contract, again, this number is holding really steady. We're sitting at about 11.5 shows per property to go under contract. So if it's taking 4.6 shows per week and 11.5 shows to go under contract, that means that you're probably on the market for about 2 weeks right now. Half of the units were under contract in 5 days or fewer. So we ended up seeing that number rebound as we came off of Memorial Weekend, but it's not as fast as it was back here in the first 4 months of the year. Price reductions. So based off of units that went under contract last week, this is different than the number that I reported for the monthly numbers. While the month of May, which is more indicative of what went under contract back in April, it was 9.6% made price reductions. Based off of what went under contract last week, it was 17.6% of those units that went under contract made price reductions. That's a little bit less than what we saw the week before, but the overall arching trend is that price reductions are definitely up in our market.
You capture it when it goes under contract or when it closes?
When it goes under contract.
When it goes under contract.
Yep. Okay. So at the point that it goes under contract, so this is based off of last week's contract data. The size of the price reduction increased. We saw 5.5% price reduction, was just up 0.2% from where we were last week. So we're starting to see even bigger and deeper price reductions, or about $51,000 for your price reduction there. The cooling trend continues continues for the under $500,000 market. Again, this was our coolest week. As we look at the first week of June, a month's supply of inventory rebounded. We're sitting back down at 0.3 months worth of inventory, which is up from the 0.1 months worth of inventory that we were looking at back over Super Bowl weekend. Average daily active count actually declined slightly, where we were down by 8.3%. Pending transactions went up week over week by about 31.9%, but overall we're down 45.2% from the same week 1 year ago. The odds of selling dropped down to 74.1% odds of selling, so it actually declined over Memorial Weekend. Memorial Weekend, we saw 79.2% odds of selling. This week it was 74.1% odds of selling. So again, that number continued to decline, and it will continue to decline through the end of the summer months. Looking at shows per property, it popped back up. We were at 8.9 shows per property, or 9 showings in the first week that you put up a new listing for homes under $500,000, and 10.9 showings should yield you an offer. So you should be under contract in 1 week if you have a home that's under $500,000 right now in Metro Denver. Median days on market was 4, so that's the point at which half the homes are under contract. Price reductions was about 8.3% of what went under contract made a price reduction, with an average price reduction of about 5.7%, or about $27,000 off of the original asking price. We're going through these numbers really fast today, guys. We had a ton to cover, so I'm going to get through all of it. I'm going to get through all of it. The $500,000 to $1 million price point, this represents about 62% of all the homes in Metro Denver. The cooling trend continued in this market. We ended up seeing that our average daily active count declined by about 3.3%. Pending transactions went up by 21.7%, but overall we're sitting at 0.6 months worth of inventory, which is up from the 0.2 months worth of inventory that we had back in January and February. So again, this market has shifted pretty drastically. We have twice as much for month's supply of inventory as what we did back in January and February, 2 to 3 times as much.
2 to 3 times off the floor.
Off the floor.
Right.
Yeah.
Perspective.
Yes. Yes. So odds of selling increased slightly week over week by about 72.8%. The overall trend is that this market is cooling as we get deeper into the summer months. Looking at shows per property, you should have had 4 showings on a property that you put up last week, and about 11.2 showings should yield you an offer. So in this $500,000 to $1 million mark, we're looking at closer to about 2 weeks on market at this point to get enough showings through before you decide if you want to make a price reduction or not. I'm advising people to wait longer to make price reductions at this point because the market isn't quite as on fire as what we were experiencing back in January and February. So rather than making a price reduction at week number 1 or week number 2, we're talking about weeks number 2 or 3 that price reductions are waiting. And if you're in the over $1 million market, I'm telling you to wait until weekends 3 or 4 to make a price reduction at that point to make sure that you get enough people through that house. We sat at 5 median days on market for homes that went under contract last week. 22% made price reductions. So price reductions continue to be on the rise in this particular price point, and the average price reduction was about $34,000, or about 4.6% off of the original asking price. 1 to 1.5 million cooling trend continues to exist. More inventory making its way to market. We had 368 total average daily active counts for the $1 to $1.5 million market. Pending transactions rebounded nicely after Memorial Weekend. It came up to 21%. Odds of selling bounced back up. We were sitting at 67.2%, but it's down from where we were back over Super Bowl weekend, where we're sitting at about 77% odds of selling. Looking at showings last week for the $1 to $1.5 million mark, we were sitting at about 3.2 showings for any new listing that you put up in the $1 to $1.5 million mark. And about 12 showings should yield you a contract. So again, that's about 4 weeks for you to sit on market if you're in this $1 to $1.5 million price point. Median days on market popped back up to 6. And so again, that's down from where we were over Memorial Weekend, where it was 8. We're sitting at 6 right now. That's up from where we were for the first 4 to 5 months of the year. We're now sitting at 6, and that number is likely to hover around 5 or 6 for the next couple of weeks. 21% of these homes ended up making price reductions. Average price reduction was huge this week. It was a 10.4% price reduction, or $168,000 off of the original asking price. Last price point that we'll talk about, and then I'll turn it over to Nicole. Looking at the $1.5 to $2 million price point, this market actually ended up heating up ever so slightly. We ended up seeing a jump in pending transactions, and our count for average daily active count to offset demand. Our average daily active count was up by 1.9% to 165 units. Pending transactions week over week went up by 58.3%. So again, don't list your luxury properties over holiday weekends.
Right.
So this really shows that there's a big pop of activity that happens the weekend before and the weekend after, especially for your luxury properties when you have these 3-day holiday weekends. The odds of selling came back up to 58%, which increased 5% week over week, but it's down from where we were over Super Bowl weekend, where we were sitting at about 73% odds of selling. 3 showings on a property that you listed between $1.5 to $2 million. 12.1 showings should yield you an offer. And so again, it could take 6 weeks to get these units under contract. They're between 1.5 to 2 million. You really have to reset your seller's expectations as to when you need to make price reductions, that you're not going to be under contract in the first week in this market. 6 median days on market for this particular price range. We ended up seeing that nearly 30% of all the homes that went under contract last week made a price reduction between 1.5 to 2 million. So if that doesn't signal a cooling trend in our luxury market, I don't know what else does. The price reduction was about 8.3% off of the original price. So about $156,000 off of the original price for these properties that were over $1 million. And so that takes us right up to 10:30. So I will stop my share. And hopefully that makes everything work for Nicole's presentation, so she doesn't get stuck in the same duplicate slides that I have. So hopefully that answers all of your questions. We had some chat windows. Do I include multifamily buildings like sales of 10-unit complexes? So no, I don't. Because those are considered to be commercial properties once they're over 4 units. So I don't include those. In regards to the back on market, what other status other than pending to active are there? So if it was expired or withdrawn, and then it goes back into an active status after that, within a 30-day period of it expiring or being withdrawn from the market, that can also trigger a back on market. And how do you see so many price reductions yet so many over listing price? Can you please explain? So people are reducing their price to the point that they're getting multiple offers after they reduce it to fair market value. And so, that's what we're seeing is once they get it down into fair market value, it's spurring those multiple offers in the marketplace. And so, yes, there's a copy of the slides that will go out to everyone that registered for today's meeting by about 1 o'clock today. So we'll get you guys a copy of it. We also post everything in the Agent Ignite group that Nicole does. And so make sure that you guys get a copy of that as well.
So with that, I'm going to get started on the economic side. I mean, that's the thing. It's like people want to sell it for what their neighbors sold it for 3 months ago. And during times of transition, we have to be the ones that educate them and get in front of this to let them know that you are only hurting yourself. If you have that price reduction, I mean, per the DMAR report, and I'm sure you can speak to this too, like if you had a price reduction, you were on the market an average of 28 days compared to like the 4 days, right? Or 6 days. So the pain that you are inflicting on yourself as a stubborn seller is monumental, because it will come back down. And then if you bring it back down enough, you'll have the multiple bids. You might even get back to where you wanted to be. But certainly the time and the angst and the stress and not sleeping at night is worth something. It's probably worth a lot of money, in fact. All right, so I am going to share my screen and let's start doing this thing. So let's talk about what's going on. It just takes me a second. Okay. All right. So we started out with this: education is the most powerful weapon that you can use to change the world. And I wanted to say this again, because we have a building and investment empire class tonight. And we're not doing it on Zoom. We're only doing it in person. It's a happy hour. It's sold out. So I'm actually telling you about something you can't come to unless you already got tickets. So we sold 80 tickets. It's just in our back room. So we're counting on the fact that, you know, a percentage of the people won't show up because I can't fit 80 back there. But this is the thing, right? It's the education to support people where we can change the world. Nelson Mandela did a totally different changing the world than we do on a daily basis. But what Megan does on a daily basis, what I love to do on a daily basis, and what I know you're working so hard to do on a daily basis, is to change the world one home buyer at a time. Because as we look at this, I mean, the opportunity to build wealth that the 80% cannot build in any other way is through real estate. right? Because I'm not buying Marilyn Monroe prints for over 100 million, but I'm buying a house and then I can buy the next one and the next one. So this is using a conservative 6% growth that the Denver market historically has seen, buying today's home price with today's interest rates. That kind of increase in wealth is a game changer. You're changing the world. You're just getting to change the world one buyer at a time. And hopefully you're getting to do it for yourself at the same time. So let's jump into what's happening on the actual market economics and the headlines. So I wanted to start out with the headlines because this is what your clients are starting out with. I mean, let's get real. They are being bombarded right now. And this is not the only slide I have in this presentation that shows you the massive effort that is going into freaking out the public. And it's working, right?
It makes me so crazy. It makes me so crazy. I've turned off the news for the last 2 weeks because I can't handle, it's just death and destruction. And it's too much doom and gloom.
And you're seeing it. You're seeing the posts on Facebook. You're seeing the news articles like shed everything, sell everything at a discount, hunker down. The worst is yet to come. And I don't want to sit here and say that things aren't going to change and that we might not hit some level of a recession and we might not lose money in the stock market. I'm speaking to all of you that had any money in the stock market in the last month, right? I mean, we're going to take some hits for the revival that we all experienced over the last 2 years. But these are just some of the headlines that they're seeing on a regular basis, including the cooling, and that we're in crisis mode, right? In fact, several high-profile names also issued economic warnings. So JP Morgan's Jamie Dimon said that a hurricane is on the horizon. He went on to say that he wasn't going to speak to the massiveness of the hurricane. It could be a small one. That wasn't captured in the headlines. What was captured in the headlines is that he said that we had a hurricane on the horizon. Elon Musk talked about he had a super bad feeling. We are seeing people that had hired a bunch during the 2020, 2021 kind of expansion of opportunity and trying to fit or meet some of the demand. We are seeing some people pull back. We're seeing lenders are letting some people go. We're also seeing some manufacturing folks are letting some people go. So to see Elon Musk, obviously he carries a lot of weight as the richest man, I think, on all galaxies. I don't know, whatever. You can't even spend that much and you can't take it with you. I'm just saying. And then BlackRock's Larry Fink predicted that this kind of high inflation, this inflation spikes, we're going to continue for years. So let's talk about inflation really quickly because the CPI number actually comes out tomorrow. So I won't be able to talk about it here. We'll probably address it a little bit in the Saturday blog that we put out. But the CPI peaked in March and then it fell 0.2% in April. And in May, it's expected to be flat, not lower. And we have to remember that this is a continued increase or decrease. This inflation is still continuing. Inflation is still high. If it's 8.3% again, it doesn't mean that inflation has stopped. It just means that the perspective compared to last year is we're still in a high inflationary market. And you're going to see that. You're going to see some traveling up and down. That's coming out tomorrow. But where inflation hurts us the most and Americans the most is in our ability to pay for our retirement, right? I mean, because that 401k money was put in over here. And if it's in the stock market, it's probably not even doing as well as it had been doing. But the high inflation is taking away the purchasing power of that money, unless I'm getting returns that are greater than inflation. That's where real estate comes in. Real estate continues to be the hedge against inflation. You're purchasing an asset using today's dollars, and as inflation continues, that asset stays the same. That mortgage payment stays the same. It is fixed. And the bonus on top of that is if it becomes a rental property or you buy it as a rental property, the rents are part of inflation. Rents continue to go up, yet the payment remains the same. So between appreciation that happens during inflation, during increasing rents, that loan to value continues to increase, which is a natural discount on that bond. Well, that bond product, which is a mortgage. All of this is talking about why we always talk about the fact that real estate is a hedge against inflation. We talk about it, but we don't talk about the why behind it, right? This is the opportunity. Of course, Powell is going to come out and he's going to do everything he can because inflation is not transitory, right? That was finally figured out. So here we are, and he's doing the quantitative tightening, which we talked about last week. And in my email after the fact, I said quantitative easing. That was fast fingers. So he's doing the quantitative tightening where they're rolling off the balance sheet and of course, raising the Fed rate. They meet again next week. They're expected to raise it 50 bips next week, 50 bips the month after that. If you have a HELOC, those two rates go together, the Fed rate and the prime rate. Be careful. I get the fact that they're cheaper and easier to get, but you have to think about the risk involved in HELOCs. So he's going to keep talking about this, and he's going to keep doing what he can to slow down inflation, which in turn slows down the economy, which in turn has the effect of putting us into a recession. Now, a lot of economists will say that the recession is going to be brief, but it is a recession nonetheless. So the home price expectation survey just came out this week, which is always good information because they take 112 economists and housing experts and they interview them, they do a survey, and they talk about several questions. One of the questions is, when do we think that the recession is going to begin? And the majority of those economists and housing experts say it's going to happen next year. And that's what my gut tells me. Although they did not survey me, I'm a little upset about that.
I know. When are the people going to start asking us?
I mean, yeah, we need to get on the list.
I need to be on a list someplace.
I will start working on. I'll have Cara start working on that.
Nice.
For both of us.
Nice.
All right. So the majority of them say, interestingly enough, there's a percentage that still say it's going to be after 2025, and there's a few 6% say it actually already started Q1, because we do know that Q1 we actually saw a decline in GDP, and you could say that was part of it. Although I still kind of blow off Q1 due to all the supply chain issues in China shutting down. But we'll see. We'll see what Q2 and Q3 bring. The other question that they asked these experts and economists is, where do they think the home price appreciation is going to go? I know that's a question that your buyers are asking, that you're asking. How do I plan for this? And it really goes into effect when we talk about the fact that the month over month price points are going down. Mm-hmm. Well, my thought is I should wait, right? I know better. We know better.
We know better.
But that's a question. Your clients are probably asking, I should wait. Interest rates might go down, home prices might go down. I should wait to get a better price. But we saw that as sellers reduce their price more towards what the market will bear, the market comes in and buyers want to buy on the dips. They see that as a sale. Oh my gosh, the seller dropped their price. Now we've got buying on the dips. So this interesting number, this black line right here is like the all-in, right? And then you have the optimists and the pessimists. So even the pessimists are saying that they expect over the next 5 years that the appreciation is going to go up 9.3%. You see a little dip in here, and I'm like, what are they thinking? When they break it out by year, it's actually a slowdown in 2023. I was talking about on the live earlier this week that there are some economists that are coming out saying that they expect as little as 0% appreciation next year. That could be rare. It could happen. I still think when you're buying real estate, that you're still getting, yes, the opportunity to appreciate, but if you don't, you still have principal reduction. You still have a hedge against inflation. You've still locked in that mortgage payment versus rent continuing to go up. There's 1,000 reasons, if I got put in a corner, I could come up with why you should still buy real estate, even in a zero appreciating market. But these pessimists aren't saying zero. They're saying that it's going to come down from 4.7 to 4.2, back up to 4.4, 6.1. So they're saying that there's going to be a little bit of a softening during this recession, not zero, not negative, not losing value, but then continuing to go up. This is a fantastic slide to put on social media or to share with your buyers who are thinking about waiting until the prices go down. Prices will soften. They will slow. They are not going to depress. Right? Because we just saw CoreLogic just came out with their April numbers. They're always a month behind. They came out at 21% nationwide. Nationwide, 21%. That is still crazy hot. March was the height. Denver market saw 21.7. If I compare that to our month over month, what did you, so in, I don't know if you remember April, that's kind of reaching back, but the DMAR April number, because I gave myself a hint and I wrote it down, was 19%, was year over year median price growth was 19%.
Mine was about the same.
Same?
Not the same.
So to see the 21.7, the difference between that, we're watching median, or you can look at average. Median is probably a little bit more accurate, but that's what is selling. What are those different homes that are in those, creates the median price. This is looking at the specific homes every time they sell. The number's always going to be a little bit different because they're actually measuring appreciation, not the variability on what has actually closed. So May, it'll be really interesting to see what they come out with next, showing that we did have that slowdown and our year over year was much lower, closer to 14%.
Yep.
This has created incredible equity. We talk about that all the time. Black Knight just came out with their updated report showing that we now have hit 11 trillion in tappable equity. Now note that this is just on properties that are mortgaged, and it's at an 80% loan to value. So this still leaves a ton of equity in the market. Yet there's 11 trillion in tappable equity that buyers can tap into, can pull, right? An average of 207,000 per homeowner with a mortgage. This is just mortgage data versus all homes. This is fantastic opportunity and goes to all the things that we keep talking about. You have to have forced selling in order to have a reduction in prices. In order to see a depreciation, you have to have forced selling. There's no forced selling if I have 11 trillion in tappable equity. And here goes the strength of this tappable equity. 33% of those mortgages of the tappable equity is locked in under 3%. 75% is locked in under 4%. They're not selling. Right? They've got a ton of money in there. And then if I look at it by credit score, 70% of the tappable equity mortgages all have above a 760 credit score. Only 10%, less than 10% have a 680 or have a less than 680 credit score. Continued conversation starters for people that are talking about the fact that we might see a housing bust and we might see housing prices deflate. These are the kinds of things that you want to be armed with so that you can pull these out and talk to them about it. So Fred puts out a report looking at the total value and the total debt on mortgages. So looking at that does not look at mortgage property. It's just what's the total value of real estate, 1 to 4 properties, and what's the total debt on real estate, 1 to 4 properties. We have even more than we were talking about, right? Because now this includes all those homes that don't even have a mortgage, which is over a third of them. Closer to 40% of homes don't have mortgages today. So this is an incredible amount of equity that we have that is just going to create a position where we aren't going to have forced selling. The other side of this idea that we are not going to have forced selling, that we're not going to have a reduction in prices, that we're not going to have a housing bust is the inventory. And we talked about this. I mentioned I had that slide. When we start seeing inventory come above, we just saw it break above year over year. Now to see it break above 2020 and 2021, that's when we're going to get to a point to where Denver's going to feel balanced, right? Not the 32,000 that it actually would take to be technically balanced, but we're just not even going to go there. We still have birth rates. We talk about this all the time, but in context, this is part of the situation that says we still have a remarkable 3 to 5 years ahead of us. I was talking to some of the folks over at DMAR. I know that we're on the lending side, we're seeing lenders leave the market. We're seeing either big lending companies lay people off. We're seeing people leave. We're seeing people retire. They just had the best 2 years of their life. They don't want to do this anymore. They don't want to get back in the street. We're also, I was talking to DMAR, they were expecting a number of realtors to bag out, to go find other jobs because they're not making it. And I'm thinking about this going, we have the next 3 to 5 years of remarkable demand. Is it harder to do our jobs? I don't know. You have to be more on top of the industry news, more on top of what's happening on the economic front, more on top of what's happening on the trends, so that you can communicate with your buyers, so that you can speak to them. You want to have a niche. What's your marketing niche? How are you reaching out to them? How are you showing them that you add value, that you can create or help them create financial wealth? Really diving deep right now during this time of change is going to be the thing that's going to create incredible business for you, I think.
Yep. It's shift brings out the best of us.
I think so. I think so. So these are the opportunities. We still have an amazing 3 to 5 years in front of us because of birth rates alone. This demand is going to continue to put pressure on a very limited inventory. Yes, we have more inventory, but more of less is not that great yet. But we feel like it because we've been in starvation mode for 2 years. A piece of toast feels like a chef's dinner, right? And it's like, come on. So, but yes, I get it. We have more inventory. We talked about this a little bit when Megan showed how few of foreclosures, but when you look at the Colorado market, we're just down here at the bottom. 1.7% of all of our homes are in any kind of delinquency status, and 0.1% of our foreclosures. This is the list we want to be at the very bottom of, and we're doing a fantastic job. We have an incredibly strong housing market. Mortgage originations, just going to show, so we made the number 11 spot of where people are getting mortgages. So anybody says that there's a ton of cash in this market, I get it. It feels like it. We still have plenty of people buying with mortgages, and they're buying it and they're extremely well positioned. 741 credit score, 76 on average loan to value. The strength of our real estate market isn't getting weaker. It's continuing to be strong. People are putting money down. People have strong credit scores. People are continuing to safeguard that asset, right? And the growth opportunities for it. We're just not going to have forced selling. Nationwide, we have incredibly strong credit score and incredibly strong borrowers. The number of folks that have 620 to even 660 are way down here, right? Most of our borrowers today are either cash or very high qualified. So let's talk about those interest rates. So Freddie Mac went up. So that report just came out this morning. Freddie Mac went up to 5.23. It had settled down. Some of the other surveys show that we're more closer to 5.5. But Freddie Mac, please note, because this is what the headlines pick up. The headlines are always going to pick up Freddie Mac, not MBS or not some of the other surveys. It also includes a 0.9% discount. So to get really excited about 5.25, if you have to pay a point to get it, it might or might not work, especially for those first-time home buyers. So really, we're looking at an average, doesn't mean everybody, an average nationwide of 5.5% interest rate without paying down points. Because this is what we saw in the 10-year. We saw this nice little dip. My gosh, I did a ton of lives. I talked about it. I put it on social media. I was the megaphone for opportunity for home buyers, right? You guys talking about Memorial Day weekend, my team owned it. And those of you who had buyers that were out working, God bless the sellers who decided to ignore Megan and list their homes during Memorial Day weekend.
Yes.
Right? Because I know, because we were able to get first-time home buyers, and we were able to get VA buyers, and we got 2 rental loan contracts under contract. Sorry, because we had this nice little dip. Well, that dip is gone. And not only is the 10-year back up to where it was before the dip, but it's actually higher. So we're seeing those interest rates peak back up again. And then to go back to the Q2 home price expectation survey, they're actually seeing that rates for the group of them, the mean is saying that rates are still going to stay in the 5 for the next couple of years. Now, look at the drop. Some people are really seeing some opportunities in this recession, but there's a lot of economists that are saying that we could still be in the 5s. So I keep talking about this fact that I hope that we have this recession, a short, easy one. And then I hope that interest rates dip, that allows people to refinance. But to have interest rates in the 5 historically is still strong. So I'm not telling you that interest rates are not going to dip or that interest rates are going to stay in the 5. I'm just telling you that 113 economists think that. So there you go. Now, mortgage purchase applications came down with the headlines that demand has dried up, that mortgage purchase applications or mortgage applications are down to a 22-year low. I get that. That's kind of a big deal. But those mortgage applications include refinances and purchases. So yeah, we're at a 22-year low because we just had a heyday. And I just showed you the slide of the number of people who are locked in under 4%. So refinances are only happening if you have a divorce or you're pulling cash out or you have a situation where you're consolidating debt. Mm-hmm. Those applications are going to go down. This should not freak anybody out. You should actually do a video or talk about it on social media about getting deeper into the data. Now, mortgage purchase applications did go down because we do have rising interest rates and we have higher prices, but not to a 22-year low. If you look at this, we're actually still above where we were most of the last decade. So it went down 7% week over week and 21% year over year. We still have a ton of people in our pipeline that are TBD approved, to be determined, looking for a contract, looking for that purchase price. They don't need a new purchase application. They already did it. All I need to do is find them a house to buy. Right? So we need more listings. We need more buyers. We need to have these conversations to get those buyers out of renting and off the fence and into the pipeline because we're fighting this, right? We've got some listings that aren't selling. Yet we have some buyers who don't want to buy because of the high interest rates and the high prices. So we have both camps where it's not a good time to buy, it's not a good time to sell, until we talk to them. And we have to be super positive. We have to talk about all the opportunities. So I was thinking about this, and my team put together kind of a set of tools, and we're going to put this in the Saturday blog as well. And if you want this for your specific zip code, we can send this out to you. I've talked about these tools in previous talks here or lives, but we've talked about them kind of one at a time. As a tool set, they actually work really well to convince your buyer that the opportunities are still in front of them, right? They didn't lose them. Yes, if you could have bought a house 2 years ago and you didn't, and you're kicking yourself in the ass, I get it. But the opportunities are still in front of you. So how do you convert more buyers into contracts? You use these tools. So first off is a real estate report card. And this is really going to be focused more on the supply and demand metrics and appreciation forecasts. So we're not looking at the specific detail that Megan goes on a weekly basis. Add that to this, right? So a report card per zip code, then you've got the buy versus rent that shows how much money you're leaving on the table. Rents are going to continue to go up. Buying fixes your mortgage rate right there, and it's a hedge against inflation. So what are those real numbers on buy versus rent? Then throw in a bid over ask for when they do actually get real about their price. And now there is competitive bidding. What does that look like? Yeah, like it's very important to him.
Yeah.
Somebody's honking, and I don't know if you can hear it on the mic or not. So bid over ask is talking about, what does that look like when you do have to do that? Don't give up. Don't not do it. You still have the opportunity to gain that value back. And then what is the cost of waiting really, really costing you? Because it is. While you're saving to fix your credit or more down payment, you can't save fast enough for an appreciation market that's still 19% year over year, 20% year over year, even if it drops down to 14% year over year. All right. So sellers, I couldn't leave you out, even though you're not on my side of the transaction. I don't get to work with you, but Megan does.
I do. I do. Let's talk about sellers.
Right. So here's a couple things from the lending side that you can work with your lender, me. Let's be clear about that. Things that I can help you with so that we can get more business to Megan, right? That's how the cycle works.
Yes.
So here are the things. If you've got one of those listings that's on the market 1 or 2 weekends, just throw in some ideas, and there's more ideas that we can brainstorm. There's a 1-0 and a 2-1 buy down where you can actually buy down the interest rate for 2 years. It's for 1 year, a bigger step, and then a lower step at 1 year, and then it's back to the regular interest rate. Or you can do a 1 year where you're only buying down the rate 1 year, and then you go back to the regular interest rate. You could also, so a seller can pay that. In fact, a seller has to pay for that buy down. The seller can also pay discount points. Say, I will pay 1% of your loan amount to drop your interest rate. I mean, that's going to cost you less than dropping your home price, and might draw somebody in that's putting that against 2 different opportunities. If you have an ADU, we'll talk about that in a second. That's a huge thing. You can also buy out the MI. If they're only putting 3 or 5 or 10% down, let them know that you'll pay their MI for them up front. That could cost you less than dropping your price. Or if you have HOA, you could pay the HOA fee for the next 1 to 3 years. So you're putting that on the closing disclosure. Now, you do have a limitation on the interested party contribution, and you'll want to ask what the limitation is, because it's based on how much the buyer is putting down on their loan. So you definitely want to ask that question. So, and we can provide financial sheets for every listing if these are things that you want to do that you've been on the market for more than a week. And if you have an auxiliary dwelling unit in the backyard, you better be selling it, because now I can use the rental income to qualify. I can pop somebody from a $600,000 I can raise somebody from a $600,000 qualification. Wow, that word was so hard.
And that was really hard.
It was really
hard.
To 711,000. I mean, that's over 100,000 jump in qualifying if you have an ADU in the backyard. We have buyer pamphlets, and we have investment pamphlets. Everybody tonight will be getting an investment pamphlet. But if you want these co-branded, we can do that too. These are the kind of tools. And don't miss absolutely RSVP, because we do have limited space. Megan and I are going to be in person in the back room next Thursday. We'll also be on Zoom for those of you that want to watch on Zoom with Gabe Bodner, who's going to be talking about how to get more listings, getting creative, and using retirement mortgages. I can't wait. That's going to be a lot of fun.
That's going to be a good one.
That's going to be a good one.
It's going to be a good one.
All right. So let's stop our share, stop our screen, see if we have any questions. What an incredible day. Oh my.
Lots of comments.
Okay. We got a couple minutes. It doesn't make sense to buy the rate down. It depends. It depends. I was just talking to a buyer yesterday where they were getting into a position where they had a 1 year of tax returns and it was a really good year for them. And so if they bought their rate down, they didn't have to think about it going forward. And it was a great qualifying year. I mean, you've got situations where buying the rate down and not having to dance around the refinance makes sense. But I think that we're going to have a recession and I think that we're going to see lower rates, but you can't hold anybody to that as a truth. We just expect at this point. Miss Leanne, you too rock this Denver Metro. Thank you so much. Okay, you're just talking, we'll catch up with you. Oh, I think it's just a lot of thank yous.
Yeah,
does it make sense to buy the rate
great.
down? Where can we get the report card? We're gonna include that in our email that we send out this afternoon. We're going to include a sample. If you have a zip code that you want specifically, reach out to me and we'll put that whole package together for you. Talking about game changing. You've got buyers that are sitting on the fence. Let's get them off. The sooner they do, the more that you're going to be able to impact their long-term financial health. 100%, hands down. Do we have numbers for mortgage purchase applications drop in excluding refinances? Yes, that was in the second slide that I told you that we're down 7% week over week, and we were down what did I say? 17%. Right there. We were down year over year. 21%, 7% week over year, 21% year over year. All right.
I think we got everything.
I think we did.
So awesome. Thanks again for joining us, guys. We really appreciate it. You joining us every week. And thanks for following us over at Thursdays. We really appreciate it. We'd value your feedback if you like having this on Thursday or Friday instead, because we're considering that this may be something that's a better Thursday event than a Friday event. So that you guys have this information headed into the weekend. So we'd value your feedback if you like having Thursdays rather than Fridays, because we know that showing days are on Fridays. But let us know what we can do for you. We want to make sure that we're providing you value so that we see what our closing tables. So please keep us in mind for your upcoming transactions. We hope that you guys have a great rest of your week. We'll see you guys later.
Bye-bye.